this figure, not this figure. In percentage of sale method, we find out the method is giving us this figure, but aging will give you the total balance of account allowance for uncollectible debt. Right? Here we go. It means, let me just clarify you here. So in percentage of sale method, the percentage of sale method will give you this account, this this figure, right? And the balance is 88. But in case of aging, it will give you this figure. The aging will give you this figure, right? So it means you need to recalculate what adjustment we need to make. So entry would be 98 minus 10, which is the beginning balance of allowance for uncollectible accounts, 88, not the 98. So many students, they confuse, they make the entry of 98. Remember, 98 is the total balance, the amount needed to be adjusted by the allowance. So total adjusted value minus any balance that is left in account in allowance. So that would be your entry, 88. Entry is the same, uncollectible account expense to allowance for uncollectible, 88, not the 98. Remember, we find out 98, but we are making the entry of 88 because we have 10, already have the balance here. So how we are going to account for this? Here we go. So the aging will give you this total balance figure. You need to figure out, so this is the balancing amount, 88. And how we are going to adjust this 88? We make the entry, the uncollectible expense to allowance for uncollectible expense. Be less 11028 minus 88. That is the NRV, which is 10,930. That would be shown on balance sheet, and this figure will show on income statement. Any question?
Mayo.
Minsu? Misha?
Yeah, on that previous slide, the 10 again. I'm just looking at it. Where did the one that we subtracted actually? The one that we subtracted. We subtracted 10. I don't know why.
Subtract the 10 from balance. Okay, let me give you.
Right.
Let me give you more explanation for this one.
Sure.
So this Jumu whiteboard is not good, but the Microsoft whiteboard is very good, but it disappears whenever I press wrongly in my finger. If I'm going to use this one, please guys neglect my bad handwriting. I'm trying to write slowly. Okay, the percentage of sale, if this is allowance, and if you have a previous balance 10, so percentage of sales method will give you this figure. And your total is 88. Right, Misha?
Mm-hmm.
But the aging of receivable will tell you the total amount of, total balance of allowance, which is 98. So we need to make entry of this figure. So what is the figure? How we can how we can calculate this figure? So how much we add in 10 to get 98?
Right, we subtract that. Okay.
Right.
Okay.
So entry, we will make this entry of the star. Entry would be the same. The uncollectible expense to allowance or reserve for uncollectible.
Why is it that we know, like we have the data to calculate uncollectible amount expense in percent of sales, but not in aging of receivable?
We do know that.
Well, I guess we do, but we have to like do this subtracting of the current accounts, current allowance account operation.
Let me just wait.
Maybe I'm phrasing it wrong.
Can you see the slide here?
No, we can't see now.
Okay. Where is that? Here, can you see that?
Yes, now I can.
So you're talking about which slide? This?
This one. Okay. Wait. No. I just meant like why? How do we know when to subtract the current accounts when we're doing the age of receivables, right?
Yes.
Okay.
The aging of receivable, in that case, in order to find out the amount of the entry here, this, in order to calculate this figure, you basically minus all the balance left, because this 98 is coming from aging of receivable from previous slide here. From this minus any balance left in account in allowance for uncollectible account. That's it, right?
Okay. It's just for this year, right?
Yeah. So that is the minor difference between percentage of sale and aging of receivable. That's it. So that is just entry is the same, which is uncollectible expense.
Okay, I think I get it.
Allowance for uncollectible. Okay, before going to the next learning objective, let's have a break, and then we are going to start after this break.
Sir, I cannot hear you clearly. It's lagging a lot.
Okay, now can you hear me?
Now I cannot hear you.
Me neither. Now can you hear me?
Gone.
Okay, I'm just saying that let's have a break.
Okay.
How many minutes, sir?
Short break. Hello, students, and welcome back after a short break. Okay, let's start our new learning objective. Okay. So writing off uncollectible accounts. So everybody, please tell me, are you clear with the percentage of sale method and aging of receivable method to create allowance for uncollectible?
Yes.
Yes.
Okay, good. Okay, let's move forward. So now we are going towards writing off the uncollectible accounts. So we have given the subsidiary account as well, and we have given the allowance for uncollectible as well. Let me read this illustration. Assume that at the beginning of the fiscal year 2013, Apple Incorporation had these accounts receivable. So we have 9 million RS, 3 million TS, and others are 11,016 million. And we have allowance for uncollectible 98 million. So let's just see our, so total accounts receivable, they are 11,028 million. And the net realizable value or net is 11,000 minus this allowanceable 98. Answer would be this amount. Okay, now what happened? Early in fiscal 2013, Apple Incorporation Credit Department determines that Apple Corporation cannot collect from RS. So then write off this receivable with the following entry. So now what happened? How much is the value of RS? 9 million, right? So look at our previous. So RS is not going to give us. So how we are account for this? Actual write-off. So remember, the entries we planned over there, it is uncollectible account, uncollectible expense 2, allowance for uncollectible, right? So we deduct the uncollectible in advance, and now reality happens. So 9 millions, they are not going to pay us, we are sure about that. So we charge this 9 million to the allowance. That's it. So make a reverse entry, and that is allowance for uncollectible accounts to account receivables. So remember, there is no expense here because we already charged expenses. Guys, you're following me?
No, where do we charge the expenses?
Here we go. So we charge in advance expenses. According to aging of receivable method, 78% sale is 78. So we already in advance made an expense. If we charge more expense, that expense gonna increase, right? So it means we are not going to charge expense to the already charged expense. We will charge expense to our reserve. It means, so if we make a reserve, so anything happen, we charge expenses to these reserve. So reserves start decreasing, and we are not, we already made in advance the expense remain the same. Understand? So it's like that, we create a reserve, an allowance in advance, right? And if anything happens, we charge first to this reserve. If reserve is like eliminated, then we can charge, then we can increase the expense. So look at here, what's happening here? RS is not going to give us 9 million, right? This 9 million, right? So we have already made an allowance, 88 million according to aging method, right? I think the question already gave us 98, right? So 98 we already have in total. 98 we have the allowance. So if anything happens,